Have you ever wondered why the stock market behaves like a roller coaster ride? It's a thrill for some, a nightmare for others, but undeniably a part of the journey for everyone who ventures into the financial world. This roller coaster ride is a manifestation of what we call market volatility. Imagine a calm sea, its surface smooth and unbroken, then all of a sudden, a storm hits and waves start to churn. That's a bit like the financial markets. In calm times, the prices of securities are steady, but when the storm of volatility hits, prices swing wildly. Volatility, in essence, refers to the degree of variation in the trading prices of securities. It's the measure of the frequency and severity of these price changes, reflecting the level of risk or uncertainty in the market. Understanding volatility is crucial for anyone involved in trading or investing, as it can greatly impact the value of your investments. So buckle up, let's delve deeper into understanding market volatility. What causes the stock markets to act like a pendulum, oscillating between highs and lows? The answer lies in a number of factors that together weave the intricate tapestry of market volatility. Firstly, we have economic indicators. These are key statistics about the economy that can indicate the direction it's heading. Think of it like the vital signs of the economy's health. These indicators include inflation rates, employment numbers, and GDP growth. When these numbers fluctuate, they can cause ripples in the market. For instance, if employment numbers decrease unexpectedly, investors may become wary, leading to a sell-off and causing the market to dip. Next, we have geopolitical events. These are incidents that occur on the global political stage and can range from elections and policy changes to conflicts and natural disasters. These events can create uncertainty in the market. Uncertainty, as any seasoned investor will tell you, is a major driver of market volatility. For example, when the Brexit referendum results were announced in 2016, it sent shockwaves through the global markets, triggering a period of increased volatility. Finally, we have investor sentiment. This is essentially the collective mood of investors. Are they feeling optimistic about the future, or are they worried? The sentiment of investors can often be a self-fulfilling prophecy. If investors are optimistic, they buy more, driving prices up. If they're pessimistic, they sell, pushing prices down. This sentiment is influenced by a myriad of factors, from the latest news headlines to the performance of individual companies. So what's the takeaway here? Market volatility isn't just the result of random movements. It's a complex phenomenon influenced by a variety of factors. It's the result of economic indicators giving us a glimpse into the health of the economy, geopolitical events creating waves of uncertainty, and investor sentiment reflecting the collective mood of the market. So these factors collectively contribute to the erratic behavior of the market. Ever heard of the term fear gauge in the financial markets? Well, if you're intrigued by that name, you're not alone. This ominous-sounding term is actually a reference to the volatility index, or as it's more commonly known, the VIX. Now, you might be wondering, what is this volatility index? Simply put, the VIX is a real-time market index that represents the market's expectations for volatility over the next 30 days. It's calculated using prices of options on the S&P 500 index, which is widely considered a benchmark for the overall US stock market. But why is it nicknamed the fear gauge? Well, that's because the VIX tends to rise when investors are fearful or uncertain about the future. In a sense, it's a measure of how much investors expect the market to swing, either up or down in the near future. So, when the VIX is high, it signals that investors are expecting large swings in the market, indicating increased fear or uncertainty. Conversely, when the VIX is low, it suggests that investors expect little change in the market, implying calm and confidence. Now let's delve a little deeper. The VIX doesn't predict which direction the market will move, only its expected volatility. It's not a crystal ball, but rather a barometer of investor sentiment. It provides a snapshot of expectations, helping investors to understand the level of risk and uncertainty in the market at any given time. And here's another interesting fact. The VIX is often inversely related to the performance of the stock market. When the stock market is up, the VIX typically goes down, and vice versa. This is because when the market is rising, investors tend to feel confident and see less need to buy options for protection, which drives the VIX down. In conclusion, The volatility index is a powerful tool for assessing the pulse of the market. It's like the market's weather vane, pointing out the prevailing winds of investor sentiment. Whether calm or stormy, the VIX serves as the market's weather vane, indicating the degree of volatility expected in the near term. How does market volatility impact you as an investor? Well, let's dive into it. Market volatility, like a tempest on the ocean, can churn even the calmest of waters. For investors, it signifies the degree of price changes in the market over time. This fluctuation can have a profound effect on your portfolio, causing it to rise and fall like waves in that tempest. Firstly, let's talk about risks. High market volatility often implies increased uncertainty in the market. This can be quite daunting, especially for those who prefer smooth sailing. When prices fluctuate wildly, it's akin to navigating through stormy seas. One moment, you're riding high on the crest of a wave. The next, you're plunging into a trough. This unpredictability can result in potential losses, especially if decisions are made in the heat of the moment, driven by fear or panic. However, it's not all doom and gloom. Just as a seasoned sailor sees opportunity in the unpredictability of the sea, so does a savvy investor in market volatility. Here's where the opportunities come in. You see, high volatility often brings discounted prices. Think of it as a sale in the market. When prices are low, it's an opportunity to buy stocks or other assets at a bargain. It's like finding a hidden treasure amid the chaos. Moreover, for those who already hold certain assets, volatility can offer the chance to sell at a premium when prices spike. It's also worth mentioning that volatility can provide a chance to diversify your portfolio. By investing in a range of assets, you spread the risk and potentially improve the overall performance of your portfolio. It's like having an array of tools at your disposal to weather the storm. Therefore, volatility isn't always bad. It can open doors to potential profits if navigated wisely. So, brace yourself for the waves, keep a keen eye on the horizon, and remember, in the world of investing, sometimes the windiest paths can lead to the most rewarding destinations. How can you, as an investor, navigate through the choppy waters of market volatility? This is a question that every financial enthusiast has asked themselves at one point or another. The first strategy to consider is diversification. Think of it as not putting all your eggs in one basket. By spreading your investments across various asset classes like stocks, bonds, real estate, and even alternative investments, you can mitigate the risk associated with market volatility. If one asset class experiences a downturn, another might be on the upswing, helping to balance your portfolio's overall performance. Another key strategy is to maintain a long-term investment horizon. Market volatility can be nerve-wracking, especially when you're witnessing drastic swings in your portfolio value. But remember, investing isn't a sprint, it's a marathon. Over the long term, markets have historically trended upward, despite short-term volatility. So, don't let short-term market fluctuations distract you from your long-term financial goals. And this brings us to our third strategy. Don't panic. It's easier said than done, we know. But panic selling during market downturns can often lead to locking in losses, and you might miss out on the potential rebound. Instead, stay calm, revisit your investment strategy, and make adjustments if necessary. Sometimes, market volatility can even present buying opportunities for savvy investors who can keep their cool. Lastly, consider seeking professional advice. Financial advisors can provide valuable insights and guidance, especially during turbulent market conditions. They can help you understand your risk tolerance, reassess your investment strategy, and guide you towards making informed decisions. Remember, in the world of investing, it's not about timing the market, but time in the market that counts. So equip yourself with these strategies, stay the course, and navigate market volatility like a seasoned investor. After all, every storm runs out of rain eventually, and the sun does shine again in the stock market. So, what have we learned about market volatility? It's not just a chaotic dance of numbers on a screen, but a natural part of the financial world. Its roots can be traced back to a myriad of causes, from geopolitical events to economic indicators. We've delved into the Volatility Index, or VIX, a pulse check of market anxiety. We've also explored the impact of market volatility, its potential to rattle even the steeliest investors, but also its capacity to present unique opportunities. And lastly, we've armed ourselves with strategies to navigate these tumultuous financial seas, like understanding your own risk tolerance, staying the course, and diversifying your portfolio. Understanding and managing market volatility is not just crucial, it's pivotal to successful investing. So, don't fear the storm. Instead, to sail your ship. To navigate the market's rough seas, equip yourself with knowledge, patience, and a well-diversified portfolio. Thank you for joining us today in understanding the world of market volatility.